Silver just did something that almost never happens in financial markets. It exploded to $121, collapsed to $75 the very next day, and now sits around $83. But the strangest part of the story is not the crash. Because in the physical market, silver never fell that far. In some places, physical silver was still trading near $149. That means the metal itself and the price chart were telling completely different stories. For most investors, that sounds impossible. After all, price is supposed to reflect reality, but in the silver market, the price you see is not always the price people actually pay. To understand this, we need to understand the difference between paper silver and physical silver, because they are not the same market. In fact, they often behave like two different worlds. Paper silver refers to contracts. These are futures contracts, options, ETFs, and financial instruments that represent silver on paper. They trade on large exchanges where billions of dollars move every day. Most of those contracts never involve real metal changing hands. They are simply agreements to buy or sell silver at a future date. Traders use them to speculate or hedge positions. The price quoted on financial news channels usually comes from this paper market. That price is called the spot price. It reflects trading activity in futures exchanges rather than actual physical transactions. Physical silver is different. Physical silver means bars, coins, and bullion that exist in real vaults. This metal must be mined, refined, transported, and stored. When someone buys physical silver, they are buying real metal that must be delivered. That delivery requirement creates a completely different supply dynamic. You cannot print physical metal the way you can create financial contracts. Normally, the two markets stay relatively close together. Physical silver might trade slightly above the spot price because of manufacturing costs and dealer premiums. But the difference is usually small. This time, the difference became enormous. Spot silver collapsed to around $75 after the spike. Yet physical metal remained dramatically higher. That divergence shocked many traders because it suggested that the futures market and the physical market were temporarily disconnected. And when markets disconnect, something unusual is happening beneath the surface. The story begins with the spike to $121. That move did not happen gradually, it happened extremely fast. Rapid moves like that usually occur when liquidity becomes thin. A sudden wave of buying can push prices much higher than normal. Algorithms and momentum traders often accelerate the move. As silver surged toward $121, traders began chasing the breakout. Momentum strategies triggered automatically. The metal appeared to be entering a historic rally. But extremely fast rallies are often unstable. When prices move too far too quickly, the market becomes vulnerable to reversal. All it takes is one shift in sentiment. That shift came quickly. Selling pressure appeared almost immediately after the spike. Once the first wave of selling began, the decline accelerated. Stop-loss orders triggered across the market. Leveraged traders were forced to liquidate positions. The result was a dramatic collapse. Within a single day, silver plunged to around $75. A move of that magnitude would normally signal panic. Yet something unusual happened in the physical market. Physical buyers did not disappear. In fact, many dealers reported extremely strong demand. Investors were eager to purchase metal at what appeared to be discounted prices. But dealers could not obtain enough inventory. Supply constraints began appearing almost immediately. That shortage pushed physical premiums higher. Premiums represent the additional cost above the spot price. Normally those premiums are modest, but when physical supply tightens, they can surge dramatically. This is exactly what happened during previous periods of market stress. In times of financial uncertainty, investors often prefer tangible assets. Precious metals become attractive stores of value. Silver occupies a unique position among precious metals. Unlike gold, silver also has significant industrial uses. Electronics, solar panels, and manufacturing all require silver. That industrial demand creates another layer of complexity. When supply chains tighten, the physical market can react differently than financial markets. Futures contracts may collapse while real metal remains scarce. Another factor is the structure of futures markets themselves. Futures exchanges allow traders to control large positions with relatively small amounts of capital. This leverage amplifies both gains and losses. When leveraged traders exit positions, the effect can be dramatic. Selling cascades through the system quickly. Prices can fall much faster than underlying fundamentals change. That dynamic likely contributed to the sharp decline from $121 to $75. The futures market essentially reset itself after the spike. But the physical market never experienced the same collapse. Instead, physical silver remained scarce. Dealers continued charging high premiums. Buyers were willing to pay far above the quoted spot price. This created the extraordinary gap we see today. Spot silver near $83, physical silver still near $149 in some markets. Such gaps rarely last forever. Eventually, the two markets tend to reconnect, but the direction of that reconnection is the real question. Sometimes physical prices fall to match futures prices. Other times, futures prices rise to match physical demand. The outcome depends on supply, liquidity, and market confidence. Right now, traders are debating which scenario will occur. Some believe the spike to $121 was a temporary anomaly. Others believe it revealed deeper stress in the silver market. Because if physical supply remains tight, futures markets cannot ignore that forever. Eventually, contracts require real metal for delivery. When delivery becomes difficult, price discovery changes. That possibility is exactly why this event has captured attention across financial markets. The silver market may be signaling something unusual. When paper markets disconnect from physical markets, something important is happening beneath the surface. The silver spike and crash reveal just how fragile the system can become. Because the futures market and the physical market operate under very different rules. Futures contracts are designed for financial trading, not necessarily for delivery. Most contracts are closed or rolled over before expiration. Traders speculate on price rather than expecting to receive metal. This works smoothly as long as confidence remains high. Participants assume the system will function normally, but when confidence weakens, the focus suddenly shifts to physical delivery. Delivery changes everything. When a contract holder demands physical silver instead of cash settlement, the exchange must provide real metal. That metal must exist in vaults and be ready to ship. If many traders request delivery simultaneously, the system faces pressure. Inventories become important. Vault holdings suddenly matter more than paper contracts. Silver markets have experienced similar stress before. In past commodity squeezes, demand for delivery exposed how small the available supply could be. Paper markets can represent far more metal than actually exists in vaults. This structure creates leverage within the system. A large number of contracts can trade against a relatively small quantity of physical metal. Under normal conditions, this imbalance remains invisible. But during volatility, it becomes obvious. Traders begin asking whether enough metal exists to satisfy potential delivery demands. That question alone can move markets dramatically. If traders believe supply is tight, they begin accumulating physical silver. Dealers experience increased demand almost immediately. Premiums above spot prices begin rising. That is exactly what happened after the silver crash. Futures prices fell rapidly, yet physical demand surged. Investors interpreted the decline as an opportunity. Many believed the futures market had overreacted. They rushed to buy physical silver while prices appeared low, but dealers faced limited supply. Mines cannot suddenly produce more silver overnight. Refining and distribution take time. As demand increased, available inventory shrank. Dealers responded by raising premiums. Buyers who wanted immediate delivery had to pay significantly more than the quoted price. This is how the gap between $83 spot silver and $149 physical silver appeared. The spot price reflected futures trading. The physical price reflected real-world supply and demand. Another factor behind the divergence involves industrial demand. Silver is not just a monetary metal, it is essential for modern technology. Solar panels require large amounts of silver. Electronics manufacturers also depend on it. Electric vehicles and renewable energy infrastructure have increased demand dramatically. When industrial demand grows, physical inventories tighten. This tightening can occur even while futures markets remain volatile. The difference sometimes produces temporary price distortions. At the same time, macroeconomic uncertainty was increasing. Investors were already concerned about inflation, debt levels, and geopolitical tensions. Precious metals often benefit during such periods. Gold typically receives most of the attention, but silver can react more violently. Its smaller market size amplifies price movements. When sentiment shifts towards safe haven assets, silver can surge quickly, but that same volatility can produce sharp declines when traders exit positions. The spike to $121 may have been one of those sentiment-driven surges. Momentum traders pushed prices rapidly higher. The move became unsustainable. Once selling began, the leverage inside futures markets accelerated the decline. Margin calls forced liquidations. Prices collapsed to $75. Yet the physical market never experienced the same liquidation pressure. Physical investors are often long-term holders. They rarely sell during sudden price swings. Instead, they buy dips. That behavior helped keep physical demand strong even while futures markets collapsed. This divergence between paper and physical markets raises an important question. Which market truly reflects the value of silver? Financial markets tend to prioritize liquidity. Futures contracts trade in enormous volumes every day. Their prices respond instantly to new information. Physical markets move more slowly. Supply chains and logistics limit how quickly inventory can change hands. Prices adjust gradually. When both markets align, the system appears stable, but when they diverge, price discovery becomes complicated. Some analysts believe the futures market ultimately determines global silver prices. Others argue that physical shortages eventually force futures prices higher. History offers examples supporting both views. Commodity markets have experienced squeezes where physical scarcity drove prices upward dramatically. At other times, financial markets overwhelmed physical demand. Large speculative flows pushed prices lower despite strong industrial use. The outcome often depends on liquidity conditions. If financial markets remain stable, futures prices usually dominate. But if delivery pressure increases, physical demand can take control. Right now, traders are debating which path the silver market will follow. The gap between paper and physical prices suggests unusual tension. If physical supply remains tight, dealers may continue charging large premiums. That would keep the physical price elevated. But if futures markets stabilize and supply improves, premiums could fall. The gap between spot and physical prices would shrink. Another possibility is even more dramatic. Futures prices could rise rapidly to match physical demand. That scenario would require significant buying pressure in paper markets. Traders would need to believe that physical shortages justify higher prices. If that happens, the spike to $121 may look less like a random anomaly. It may look like an early signal. Commodity markets sometimes test extreme levels before stabilizing. A sudden spike can reveal underlying supply tension. When markets discover that supply is tighter than expected, prices adjust upward over time. The adjustment may occur gradually or explosively. Silver has experienced both types of movements historically. During certain periods, the metal has risen dramatically within months. Those rallies often begin with unusual price behavior. Sharp spikes, sudden crashes, and physical shortages appear simultaneously. The recent events in silver resemble that pattern. Rapid price movement exposed structural stress inside the market. But the story is not finished yet. Markets still need to decide which signal to trust. Will the futures market continue dominating price discovery, or will physical demand eventually force prices higher? The answer may depend on the next wave of demand. If investors continue accumulating physical silver, the pressure could grow. If industrial demand remains strong, supply constraints may persist. Futures markets would eventually have to reflect that reality. For now, the silver market sits in a strange equilibrium. Spot price around $83, physical metal near $149. Such a gap cannot remain indefinitely. Markets eventually reconcile differences between financial contracts and real commodities. When that reconciliation happens, the move can be dramatic. Either physical prices fall sharply or futures prices surge. And that is why traders around the world are watching silver closely right now, because the metal may be revealing something deeper about supply, demand, and the stability of the modern commodity market.